Yeah, so as you guys mentioned, it was a short week last week, so a little bit to catch up on this week. I would say we got November's eurozone inflation numbers. So just looking at inflation across the continent of Europe, and November was the first month of declining inflation for Europe in 17 months, so which I thought was pretty interesting. Worth noting, I think obviously that's a good sign, but I think there's still a lot of work to be done in order to lower energy prices across the long term. So 1 month of declining inflation, great, but we're not out of the water. But I think it is a signal that Europe is potentially entering a similar situation as the U.S., meaning where we have all these signs of slowing inflation, but we're just going to continue to raise interest rates and hold them elevated in order to really suppress that demand and bring down prices. In the U.S., we got October's PCE inflation numbers, which is fairly similar to CPI, but it measures a little bit of a different angle and in a different group of goods. So PCE inflation is what the Fed really uses. They don't really pay. I mean, they pay attention to CPI obviously, but they don't really use that to dictate their decision making. They use the PCE inflation. So core PCE came in under expectations, so that's a good thing. It was at 0.2% growth month over month and 5% year over year. PCE inflation is also a lot slower moving, so you're not going to see like a 10% or something like that. 5% is a really big number. So I think that's likely a good sign, right? That PCE inflation is coming in lower than expected. But we also got this morning we got the November jobs report, which indicates potentially that the labor market was pretty strong. It was interesting because there's a few different metrics that are kind of working against each other. You might see non-farm payrolls were up. I think it was like 260 something thousand, which is great. But then when you look at other metrics, you kind of see that there's some weakening going on under the surface. So that's just kind of something to keep an eye on. I think it's also worth noting that because overall, I would say the report was fairly strong for November. That would actually kind of be a bad sign for the markets because the goal of the Fed right now is to raise interest rates to suppress demand, which should bring down prices, and they also are hoping in a sense to slow down the labor market a little bit. So the fact that we've been undergoing this contractionary monetary policy for coming up on a year now, and the job market hasn't really reacted yet, could mean that the Fed has some more work left to do with raising rates, maybe higher than we were originally expecting. This week we also got the PMI data for November. That's the Purchasing Managers Index, put out by ISM. So I'm looking at the manufacturing PMI, which came in at 49%, which is right under that contractionary level of 50%. That's kind of like that break-even number. So when you're above 50% on the PMIs, you would say that the economy is still in an expanding. Versus when you go under 50%, like we did at 49%, you would say that the manufacturing sector is contracting. So PMIs is just a survey of manufacturing managers' outlook on current market conditions, and it tends to be a really accurate indicator of overall economic growth. So I thought it was worth noting that we just broke below that 50% benchmark for the month of November, and we're now back at a level that we haven't seen since the start of the pandemic in May 2020. So then Wednesday was kind of the big day this week. If you've been paying attention to the markets, right, you probably already know this, but we heard from Fed Chair Powell, which his kind of dovish speech kind of forced a lot of buy pressure into the markets, which was pretty interesting to watch. Right, if you were looking at the charts intraday, it was crazy. But he kind of took this kind of dovish stance on Wednesday, kind of stating that smaller rate hikes could become a reality as soon as December, right? And that's kind of like the soundbite that the market really, really liked. And the S&P was up over 3% on Wednesday. I thought Thursday was a relatively quieter day, but it was kind of a signal to me that this rally kind of has some strength behind it, more so than previous rallies. Not necessarily saying that the market has bottomed. Me personally, I don't really think it has, but It was nice to see that after following a super strong green day, you didn't have a bunch of short sellers coming in or a bunch of traders dumping their positions and things like that. We had a relatively lower volume day, and it kind of put in like a doji candle, and we didn't retrace all of the gains that we had made on Wednesday. So I thought that was a good sign. And today we gapped down, and we're starting to recover there intraday, which I think is another good sign. Um, I still think the long term trend is primarily down. If we look at like a monthly or a weekly chart, the primary trend is still down. So I think there's that inherent downside bias at the moment. But on Thursday, the S&P was able to close above the 200 day for the first time since April. So I think that's a great sign for the bulls, and that was kind of a key level that a lot of people were watching because on the last rally we had. Whenever that was, when we touched the 200-day last, which was in August. August is the last time we touched the 200-day, and that kind of became this big resistance zone. And a lot of people were talking, oh, we're gonna run into it again, and yada yada, and we were able to clear above it, which I thought was a great sign. And we've also seen, a fairly strong week for treasuries. Obviously, today yields are climbing back a little bit higher again, but overall it's been a pretty good week for treasury prices, and that kind of comes alongside the U.S. dollar declining, and it's cooled off a bunch, which I think is a great sign as well. Today it's continuing back lower. I didn't have a major update for the crypto exposed equities this week. I mentioned about four of them that I thought were showing some of the higher levels of relative strength this week. But that being said, there's not a whole ton to update there. And same with the Bitcoin technical analysis. Obviously, we got a nice little pop to the upside, and we were forming what I thought kind of looked like to be a bear flag, but it was kind of nice to see that breakout to the upside this week. It's something that we haven't seen in a while. And as I mentioned in the newsletter, I'm kind of just waiting for a higher high on Bitcoin's weekly chart, which is something that we haven't been able to do since March of this year. So that's kind of where I'm looking at is 21,500 is really the level I'm looking at the moment.
It's a great breakdown, Blake. It'd be interesting to see because it looks like the treasury market and the stock market bottomed out in November, and last year it topped out in November. So it'd be weird to see if it was like spot on, like 1 year of just bear market because things might be turning around. Do you think generally they're turning around? Because if the next rate hike is smaller and the market's been pricing in 75 bips, that should be enough to move the ship.
Yeah, I mean, I think that would be, overall a fairly bullish thing for the market. I don't necessarily think that means that the market has to bottom. I think, everyone's just kind of assumed for the last year that, oh, when the Fed slows down rate hikes, that means the market has to bottom, and that obviously it doesn't work like that. The market can do whatever the market wants to do. I would imagine that the market would bottom closer to when the Fed actually pauses their hike cycle. So in my opinion, I would more so see us bottoming around February, March, kind of April kind of area. That's my personal opinion, obviously. So I'm kind of in the boat of we haven't necessarily bottomed, but obviously anything's possible. I could obviously be wrong.
Do you think the bottom's going to be like a correlation to one type moment?
I'm sorry, can you repeat that?
Do you think the bottom is going to be like where all assets just drop, like a March 2020 type correlation to one kind of thing?
Yeah, no, I don't. I mean, obviously I don't know. I think it's possible, and that's kind of one of those like I hate to say like black swan, but that's like some announcement or some metric comes in way off than expected that really scares the markets. That's kind of really hard to predict. um I think obviously it's possible. I couldn't really tell you.
Blake, I saw this really interesting chart the other day on Twitter. I think Joe Consorti posted it, and it was basically a metric that was measuring layoffs, and it was like a year-over-year increase in the number of layoffs. So, like for example, the metric as of like December right now would be layoffs, as of right the second in the last month compared to layoffs a year from now. And basically it shows like, okay, dot-com bubble, they're pretty high, year over year layoff increase in layoffs. 2008, 2009 was similar to dot-com. March 2020 was pretty crazy. And then now, surprisingly, like we're near like 2008 and dot-com bubble levels of layoffs compared to this time last year. Do you have any thoughts on that? I mean, maybe it has to do with like how tight the labor market was last year and like nobody was getting laid off. So like maybe the year over year increase is just massive because of that. I don't know. Do you have any thoughts on this?
No, yeah, I think it's really interesting. I hadn't seen that before. And it's kind of one of those things where it's like, it reminds me a lot of when you look at like, if you look at the rate of change on the Fed funds rate, where it's like when you were essentially at zero and then you increase, away from zero, you're obviously going to have a really massive rate of change. In this time last year, things were great, to an extent, or at least appeared to be great on the surface, and there no one was really laying off employees. So then this year, when it's a little bit of a different scenario, obviously you're going to have that number is going to be absolutely massive, right? The rate of change of layoffs is huge. What I find interesting is that I was reading a report from Goldman this morning talking about something similar, um, just talking about how tech layoffs is not a recessionary signal necessarily, because the amount of jobs out there that are specifically tech related is like 0.3% or something like that of the total labor market. So it's like if you theoretically every single person working in tech got laid off, or like these large tech companies, I forget the specific group that they were looking at, but it would account for roughly like 0.3% of labor, which I found really interesting because they're kind of talking about how, hey, certainly it's not a good sign to see layoffs, but that doesn't necessarily mean that we're in a recession per se. But this tweet here from Joe Consori, I think is pretty cool and pretty interesting, and I hadn't looked at it yet.
Yeah, I definitely agree. I think you made a great point about how a lot of people, when the Fed started raising rates from zero, they were like, "Wow, the Fed, like the rate of change is massive. It's never been seen like this." And like it didn't really make any sense because any change from zero is going to be basically infinity. So that's probably kind of what's happening in this chart, and it's why, just because we've had some layoffs doesn't mean like the economy is actually completely imploding right now, like you pointed out.
Yeah, exactly. That's exactly what I'm thinking. Obviously, I'm sure there's a great argument either way, but that's just kind of my personal stance on it.
In hindsight, I'm kind of surprised they raised the rate so fast, and I think they're probably trying to avoid the 5% number on Fed funds because I believe that is where the interest expense like overtakes Social Security and military spending. So maybe that's why the next rate hike might be lower, so they can sort of avoid that level as long as they can.
Yeah, it's interesting. Like, and if you look at any of these ways that we like to measure the terminal rate, which is the peak rate that the market sees the Fed funds rate hitting in this hike cycle. So if you look at like the 2 year is a good proxy, the yield of the 2 year bond is a good proxy for it, which peaked out roughly at 4.8 or 4.9%, which is kind of signaling that the market saw a Fed terminal rate of roughly 5% or so. And the Fed funds futures data kind of indicates something similar, expecting a roughly 5 to 5.5% peak for the Fed funds rate this cycle. I think it's going to be really interesting to see if that's actually where we end up. I could definitely see us going higher. I think a lot of people would agree with that statement. So it'll definitely be interesting. But yeah, 5% kind of has been the benchmark for the Fed terminal rate for a few months now. So it'll be interesting.
For sure. We can shuffle on over to on chain now. Recently we sort of entered what I'm calling is like the second half of the bottom. So a couple months ago we saw the short-term holder realized price went below the long-term holder realized price. And what we've seen in the last 2 weeks is the short-term holder realized price go over just the aggregate realized price, not exclusive to long-term holders. And every time we've seen that before, it happens about like halfway through the bottom. So that if you look at the chart I put in the newsletter, it's like a green zone and a pink zone, and the pink zone is like right in the second half to the latter half of the bottom, and that's where we just entered. So that's something to keep an eye on. One of the metrics I looked at this week that I really liked seeing was the adjusted SOPR. So SOPR basically measures the realized price of a UTXO when it's created, and then when that UTXO is sent, and it sort of shows capitulation or profit taking. And we saw, based off SOPR, the biggest capitulation since the 2018 bear market bottom, which is definitely interesting and sort of, I think it's bullish. When you look at realized loss adjusted for market cap, we had a huge capitulation in June, and if you've been reading the newsletter, I wasn't expecting another one because historically, when you look at this metric, there's a one spike and then it sort of slowly declines. But we did have another one, obviously, when the price went down. But something I've been seeing is that capitulation indicates a break in the conviction of some long-term holders, right? Because if you look at the metric supply held by long-term holders, it did decline about 100,000 Bitcoin, which is not insignificant. But when you break it down further, because a long-term holder on Glassnode is anybody who's held 155 days or longer. So that's only about 6 months, that was right around when we dropped to the 20K range. So you could have bought that dip and technically you'd have been classified as a long-term holder by now. So a lot of the capitulation, it came from the supply held by the supply that was last active 6 to 12 months ago. When you look at the percentage of the supply that was last active 1 or more years, that was not the group that capitulated the other week following the FTX debacle. So Bitcoiners, they haven't been scared, right? They've held all the way down from the highs of last year. Majority of them, that group that has held for a year or longer, did not capitulate. And we understand, like, anecdotally, because a lot of the people on Bitcoin Twitter, we're not here to sell at the bottom, right? We understand the value proposition of Bitcoin as a bearer asset and an absolutely scarce monetary network. So we're not scared by the dip. The people that were scared, they're just the tourists, right? When you look at the accumulation trend score, it basically measures accumulation, but it's more weighted towards bigger bags, so whales and fish, and that's in like the high accumulation zone right now. When you look at the supply held by entities with 10 to 100 Bitcoin, they actually had their biggest 2 week increase recently, and hasn't increased this much since the middle of the 2017 bull run. And right after that happened, obviously, like, the bull run kept going, and there was a huge price appreciation after. That's not to say that'll happen this time, but it is interesting to see that group has been accumulating a lot. The open interest has cooled off now almost entirely, because if you've been following, there was a huge buildup, and there was low volatility, so we were expecting a big downward or upward move, and a lot of that open interest has been cleared out, and the funding rate has flipped, like, significantly negative. It hasn't been this negative since the summer of 2021, and that to me is a bullish sign that the sentiment among traders is so bearish. You're not going to see a bullish sentiment at the market bottom, and that's something I should have taken more note of over the past few months, because the uh, the funding rate was more or less positive. It was nothing crazy. It was flipping back and forth between positive and negative, but now it's definitely, like, noticeably in the red. So that bearish sentiment to me is bullish.
Yeah, great analysis, Mitch. I definitely think the funding rate is something that's super interesting because obviously a lot of people in the Bitcoin market and crypto market, I guess broadly, are like generally long, right? So when people are trading with leverage, the funding rate is positive, meaning to go long, you have to pay a premium to do that. And on these like special occasions when funding is negative, that means like traders are literally paying the premium and you're paid to actually go long Bitcoin with leverage. So yeah, it's just kind of an interesting dynamic that you pointed out. And it rarely happens because really, if you're in this industry, you're not trying to, short Bitcoin to zero per se. You're trying to make, 10x or 100x gains. You're in it for the asymmetric, I guess, potential return rather than trying to make a few basis points, shorting Bitcoin going down.
For sure. And something to note is like the traders, I like them or not, they are sort of what moves the price in the short run. In the long run, people taking Bitcoin off the exchange, that's the most bullish thing, but the price is set at the margin, and so traders, they don't hold an insignificant amount of Bitcoin. So it's definitely looking at their activity can give you some insight into where the price might be headed in the short run. And typically when there's this much bearish sentiment among traders based on the funding rate, it usually indicates a market bottom. But we haven't really had this metric a whole lot. Bitcoin futures contracts are relatively new, so we've only really seen this low funding once, and that was at the bottom of the mini bear market from last year, whatever you want to call that. I don't know if bear market's the right word, but there was a drawdown.
Yeah, Mitch, I also really liked the chart that you posted about realized profit and loss divided by the market cap. I feel like this chart is super easy and it's clear to tell like okay, where are the signs of, extreme hype, extreme exuberance, and where are the times where capitulation is just very obvious and severe, and like the 2015 bottom, 2018, 2019 bottom, March 2020 bottom, and then now is like pretty clear, like they're all kind of on the same level. But I think you made a great point how it's interesting that we've kind of had these two capitulations on this metric. One was this past summer, and then one was this recent, basically FTX blow up. I feel like, and I like what you said. Most people didn't expect this to happen twice because previous bear markets, it's only happened once where you had this extreme capitulation. And I feel like it may be like two reasons. Like, one, the macro situation isn't great. This is one of the worst macro situations Bitcoin's lived in. And I guess two, like the crypto industry broadly has like completely blown up, where all of the weak hands that may have held Bitcoin, have just been eliminated. I'm curious, like, do you think that it's possible for another level of extreme capitulation? I mean, I guess in my mind, I could only see like two possible scenarios, like two general scenarios. Maybe like macro gets even worse, where we have like a major recession, or two, the crypto industry sees another leg of capitulation. I don't know, maybe that's like Binance or Tether blowing up. What do you think? Like, are we going to see another wave of capitulation? And like, what could that wave of capitulation be from?
Oh, I think you're spot on. I think it's more likely going to be the a blow up of some other crypto exchange. Like, we know FTX, it wasn't the only one doing that. There's someone else out there is going to get exposed. I don't want to name anything specific. Well, maybe I will. I know crypto.com. There's been a lot of rumors floating around about them. I don't think the contagion is over. Maybe the capitulation won't be as bad from a price perspective. From like a realized losses perspective, it could be, depending on how long these exchanges have held this Bitcoin and what their cost basis was. But it'll be interesting to see. I'm sure there's probably going to be another exchange to go bust. I don't think we're over in that regards, but that's why I love looking at the supply of Bitcoin that hasn't moved in a year or longer, because we know that is most likely like in cold storage of plebs essentially, and so we know from that metric there won't be any capitulation. So that in the long run, I think exchanges blowing up and plebs buying their coins is a great thing.
Yeah, I think those are great points. I heard Jesse Powell, who led Crack or still leads Kraken, I think he brought up the idea that some people are like saying like, hey, don't like incite people to make a run on crypto or Bitcoin exchanges, and he was like, no, like please withdraw your Bitcoin from Kraken. Like if you're not actively trading it, it's actually just kind of a hassle because we don't want to have to be holding hundreds of thousands of Bitcoins for you. I mean, they don't get paid to hold your Bitcoin, and that like obviously takes resources and takes security needs. But so it's kind of interesting how he was like, yeah, like withdraw your Bitcoin from Kraken. Like, I don't care. Like, in fact, I'd rather you withdraw it if you're not going to be actively trading it. And I think that's interesting. And I think it brings a good point. It was like, might as well bring up, crypto.com or whoever and tell people, hey, like, if you're just storing your Bitcoin on these exchanges, withdraw it. I mean, if you're not actively trading it, it's probably doing everyone a favor.
Yeah, for sure. And it's funny that Jesse, the Kraken CEO, said that because he saw basically the exact opposite from Alex Mashinsky of Celsius and Sam Bankman-Fried of FTX. They're actively, going against people withdrawing it because they knew there were no withdrawals to be sent out. So if you had to go with an exchange, the safest one is probably the ones telling you to withdraw. But then again, never leave Bitcoin on exchange. But if you absolutely had to, you should probably go with one that encourages withdrawals.
Yeah, totally. I mean, if your exchange is like urging you to deposit more and they're paying you like a higher and higher yield to do so, definitely a red flag.
For sure, it's like casinos. They want to do everything they can to keep you there. They don't want you to leave and take that money and make it real.
Totally, totally. I can carry us towards mining, unless I see you're unmuted. Do you have anything else you want to add?
No, you're good. Take it away.
Sweet. So for mining this week, I have a few metrics that I put in the newsletter. First one is the 14-day moving average of the total network hash rate is sitting on just shy of 250 exahash. It's definitely been decreasing over the last week, which is interesting. And we're actually about to see the next estimated difficulty adjustment drop down by a significant amount. So the miners that been able to survive, higher energy prices, lower Bitcoin price, and higher difficulty are finally going to get a little bit of relief. Fees as a percentage of block reward over the last, I think it's like 144 blocks, has been averaging at about 3.4%. So this is something that's kind of been interesting. We've seen this trend over the last few weeks where fees have actually been, compared to the last 12 to 20 or 12 months at least, a more significant percentage of the block reward. Still very small, but kind of a helpful boost to miners who are looking for an extra few percent revenue, because everything helps at this point. Hash price, which is basically a metric that shows what a miner will earn in dollar wise per terahash per day, sitting at about 6 cents. So a machine that's running at 100 terahash is earning about $6 per day in revenue, which is pretty cool. And then the last metric that I'll talk about before I get into what I wrote for the newsletter is total mining revenue per day for the entire Bitcoin network. It's currently sitting at about $13.7 million. So that's a few metrics. Mentioned this in the metrics, but one key thing that I talked about in the newsletter was this next estimated difficulty adjustment. And in the mining industry, we've seen a lot of discussion around this difficulty adjustment, and we've covered it in previous week, the last week, because we saw that hey, blocks were coming in slow. It's likely that difficulty is going to go down, but we didn't have too much data or too many blocks to really be able to tell with confidence that it was going to be significantly negative. But now, 7 days later, we definitely still see that difficulty is projected to decrease by a significant amount. Last week we estimated it would be about down 6%. Now it's looking at it will be a little bit further potentially. We're estimating about 7%. And I kind of sometimes like to dive into the idea of like, okay, like how is Bitcoin actually adjusting its difficulty? Because we hear this a lot, like the supply schedule gets released, at a set time, but how does Bitcoin network actually know like when to adjust difficulty down, when to adjust difficulty up? So difficulty is basically adjusted indirectly based on the total network hash rate, right? If more hash rate comes online, then difficulty, needs to go up, make it harder. But hash rate cannot actually be measured by the Bitcoin network directly. So instead, the Bitcoin network actually uses block times to adjust the hash rate. So if blocks are coming in faster than every 10 minutes, and this is on average over a significant amount of time, significant number of blocks, then difficulty will adjust up. this means more hash rate has gone online, so difficulty needs to come up. If blocks are actually coming in slower than every 10 minutes, then difficulty adjusts down. And as of this difficulty epoch, which is a little over, every difficulty epoch is about 2,000 blocks, which is about every 2 weeks. The current difficulty epoch, we're like 134 blocks behind schedule. So this means blocks are coming in on average every, like, I don't know, 10 minutes and 40 seconds instead of 10 minutes exactly. And in the newsletter, we kind of have this visualization that shows, hey, what blocks have been mined for this epoch, what blocks haven't been mined for this epoch, and like what blocks should have been mined at this point at this amount of time. And so it's kind of just sometimes interesting to dive into, like, okay, how is Bitcoin actually working from a technical perspective? And how does Bitcoin know, like the network know, without any trusted third party to adjust, difficulty up or down? So it's pretty cool. Second major thing that I covered in the newsletter was this metric that Glassnode has about miner balances. I've seen a lot of people recently talking about this one on Twitter. They post pictures of, charts like the miner balances or the miner net position change that Glassnode has, and it shows ever since the FTX blew up, we saw this significant drop in like miner balances, and people are like, "Oh my gosh, miners are selling massive amounts of Bitcoin. This is crazy." And like the metric to me is it's accurate, but it's like misleading as to how people are interpreting it. Um, this miner balance metric is actually composed of individual mining pools instead of actually miners. It's very difficult to determine whether like miners are actually selling their Bitcoin. For example, like a typical miner would see kind of this flow in their Bitcoin. They'll get a block reward payout from the actual block. This block reward goes to the mining pool specifically, which is what this mining balance metric on Glassnode is measuring. And then usually from the mining pool, there's another transaction that just gets sent to the individual miner's wallet or their cold storage wallet. So there's already like two hops there. There's the one from the block reward and then one from the mining pool. And the miner balances metric is not necessarily including the one to the miner's cold storage wallet. So this could just be miners withdrawing from their mining pool and looking actually at the mining pools that are composed in that metric. The ones that have actually seen their balance drop recently were Mara's mining pool and Poolin, that mining pool. And we haven't really heard any news that Mara has sold a significant amount of Bitcoin. And kind of looking at the past of their mining pool, it seems pretty likely that they're just shuffling around coins, and they're not actually like selling coins. And then Poolin is just a relatively large Bitcoin pool where individual miners were likely just withdrawing their Bitcoin from Poolin, and we didn't see like a major inflow into any exchanges. So it's pretty likely that this is just like miners shuffling around coins or withdrawing from their mining pool. It's not necessarily that these 10,000 bitcoins that people have been speculating have been sold. It's, to me, it's not likely that they've been sold, and it seems like miners aren't capitulating actual Bitcoin anymore over the last few weeks than they have been over this entire year. Now, I think uh, after covering that, it's important to note that like just because miners may not be selling Bitcoin like in mass right now doesn't mean we're not going to see like another wave of miner bankruptcies. I think a lot of the public mining firms and private mining firms at this point, if they're like struggling big time, which many are, they've likely sold a significant amount of their Bitcoin treasury. We saw like public miners dumping a ton of their Bitcoin this past summer. Some held it out and like continue to have a decent sized treasury. I think Mara and Riot are two ones because they're more capitalized. But the weaker ones at this point for sure have basically zero Bitcoin or close to it. So just another note is just because we might see more miners filing for bankruptcy doesn't necessarily mean we're going to see more sell pressure on the price of Bitcoin. I mean, a lot of these miners that are filing for bankruptcy or are defaulting on their ASIC collateralized loans, they don't really have any Bitcoin left to sell. So it's just kind of a matter of the assets that are not Bitcoin changing hands rather than more sell pressure on the price of Bitcoin itself.
That's fascinating, Joe. I've never really understood that part where like, it goes to the mining pool first and then to like the individual miners contributing. Has there ever been like a not your keys, not your coins scenario with like a mining pool running off, or are those I know with our Blockware pool you can withdraw pretty much automatically, but I'm not sure if that's the case with other mining pools. Do you have any insight on that?
Yeah, no, it's a good question. I think I have had like heard things in the past about specific mining pools like having liquidity issues. I can't remember, one happened this summer. I forgot which one it was, and I don't want to name names if I say the wrong one. But yeah, like there have been issues, and that's why like most miners are fairly, at least miners at a decent scale, are like technically competent, and they're going to like actually be withdrawing Bitcoin fairly regularly. And like you said, like the Blockware pool, like we don't want to be holding everyone's Bitcoin, so we like have very low withdrawal threshold limits. Like if you get 0.005 BTC, or even maybe even less than that, like you can auto withdraw like every time your miners accumulate that much coins. So yeah, I think like most mining pools are like, hey, we don't necessarily want to hold all this. Um, Try to withdraw it as much as possible. But yeah, some people, end up keeping their coins in a mining pool, or like the Mara pool. I don't know exactly how Marathon, has their Bitcoin. I'm not sure how they, you know, do their cold storage, whether they have like a trusted custodian. But I'm sure there's some like different like internal processes and internal controls they have around how they store their Bitcoin, and like the relationship between that and their mining pool that they have as well.
For sure, and obviously because it's on the Bitcoin blockchain, it's a lot more transparent than exchanges with their private books. You can't really exactly see how much Bitcoin they've sold, but you can surely see how much Bitcoin a certain pool is mined, and you pretty much know that your Bitcoin is in that pool if you decide for some whatever reason not to withdraw it.
Yeah, totally. That's a good point. And yeah, it's definitely gonna be interesting to see how the mining space develops over time. But yeah, you made some great points there.
Well, I guess we can go ahead and wrap up here. If you missed anything, this was recorded and it'll be on YouTube later today. So unless you guys got any more comments, we can wrap up.
Nothing for me. Just hope everyone has a great weekend, and thanks for tuning in. Hope you enjoy the newsletter.